Hey everyone, welcome to The Explainer. Today we're stepping into the absolutely wild, highly volatile world of cryptocurrency market surges. Have you ever just watched a token absolutely skyrocket out of nowhere and thought, wait, how does that even happen? Well, you are in exactly the right place. We're going to dissect the mechanics behind the massive, kind of chaotic price movements of the BEAL ecosystem tokens, using all the latest market data and analysis. To give you a sense of the sheer scale, and honestly, the absurdity of the market we're looking at today, check this out. 4,418,757%. I mean, wow. According to predictive algorithms from CoinCodex, that is the outrageous return on investment you would need for the BUILD token to hit just one single dollar. It's a staggering number, right? And it really sets the stage for the kind of explosive, purely speculative energy we're analyzing right now. So this all brings us to a really fascinating question. Can cold, rational mathematical models actually predict human-driven chaos and market hysteria? We've got these incredibly complex formulas trying to map out a 20-year trajectory for these assets, while at the exact same time, human sentiment is just throwing the charts completely out the window overnight. It's this wild clash between math and memes. Okay, let's dive right into this. First, we'll look at the anatomy of a crypto surge, then memes and market sentiment, followed by the triggers, technicals, and leverage. Next, we'll cover the BNB ecosystem rotation, then algorithms versus reality, and finally, the speculative market mirage. All right, part one, anatomy of a crypto surge, examining the chaos. We're going to put three interconnected tokens under the microscope today: BUILD, BUILDon, and BUILDon BNB, and just kind of see how their recent price action actually unfolded. So, looking at the data, the BUILDon BNB token, or BOB, jumped nearly 46% in a single day, just completely outperforming the broader market. But here's the real kicker. There were zero fundamental catalysts. I mean, literally none. No protocol upgrades, no new partnerships, no big official announcements. This was a massive surge built entirely on momentum, not underlying foundational value. Moving to section 2, memes and market sentiment, the psychological spark. Because, if it wasn't news driving the price, what was it? Well, our source analysis directly attributes the initial spark for the BUILDon token to a viral meme, specifically a social media campaign featuring an animated Donald Trump right alongside a lion mascot. It was pure attention, not utility, that moved the needle here. This cultural, meme-driven campaign generated a huge sentiment shock, and that triggered a massive 60% intraday surge for the token. But here's the thing. A meme alone rarely sustains a rally of that magnitude. The BUILDon surge was actually driven by a triad of forces. You had the viral meme campaign, which brought in the initial eyeballs and buying pressure. But then, that pressure forced a technical breakout on the charts, and that in turn activated massive leverage dynamics in the derivatives market. It's like a domino effect. Which leads us to section 3, triggers, technicals, and leverage. Basically, fuel on the fire. Let's lift the hood and see exactly how charting indicators act like high-octane gasoline poured right onto that meme-sparked fire. The absolutely crucial piece of the puzzle here is the 200-day exponential moving average, or EMA. Now, if you're looking at a chart, this is a line that tracks the average price over 200 days, but it gives a bit more weight to recent prices. Technical traders treat this line as the boundary between a bear market and a bull market. So that meme-driven buying we talked about, it pushed the BUILDon token right above this critical line at roughly 21.9 cents. And the exact moment that happened, systematic momentum traders, who honestly don't care at all about the meme, they're just trading the math, well, they suddenly flooded in to buy the breakout. And this whole cascading effect triggered what's called a short squeeze. If you're not familiar, a short squeeze happens when traders who are betting the price will go down are suddenly trapped because the price skyrockets. To exit their losing bets, they are literally forced to buy the asset, which, you guessed it, pushes the price up even faster. Our data shows that this exact dynamic liquidated $4.67 million in short positions for BUILDon in just a 24-hour window. Talk about forcing prices aggressively higher. Now, all of this leverage inevitably leads to an overextended market, and we can actually see this through the MVRV Z-score. This is a metric that compares the current market value of an asset to the average cost basis of all its holders. BUILDon score spiked to 2.86, What you really should take away from this number is that the market value was heavily, heavily inflated compared to what people actually paid for the tokens. It is basically a massive, flashing, neon warning sign that the market is overextended, totally leveraged, and at a really high risk for sudden profit taking. All right, Section 4, the BNB ecosystem rotation, the macro wind. To really get this, we have to zoom out and look beyond the individual tokens to understand the massive macroeconomic winds pushing them. The market analysis highlights a much broader trend here. Capital is rotating into the BNB ecosystem. Over the weekend, there were structured, very intentional flows of capital moving specifically into Binance Smart Chain Alpha coins. So traders weren't just buying BUILDon randomly. They were out hunting for high upside assets within this specific blockchain environment as part of a broader sector rotation. And because tokens like BUILDon and Bob are what we call low cap and high beta, they react incredibly violently to these capital rotations. Low cap just means they don't have a massive total market value, and high beta means they are hypersensitive to any broader market movements. So when capital rotates into their ecosystem, they tend to vastly overshoot broader assets. This is especially true on weekends when trading volume is thinner, so every single dollar makes a much bigger impact. That brings us to Section 5, algorithms versus reality. Math meets memes. We've talked a lot about human, meme-driven trading. Now, let's switch gears and look at the cold, calculating 20-year mathematical prediction models from CoinCodex. The irony here is absolutely incredible. Despite all the meme hype and capital rotation causing these wild 40 to 60% daily spikes, the technical algorithm looking at the BUILD token itself actually shows an overwhelming 88% bearish sentiment. Based on historical data and a whole bunch of technical indicators, the cold math is practically screaming sell, even while social sentiment is out there screaming buy. Just look at these algorithmic predictions mapping all the way out to the year 2050. The model is anticipating slow, cyclical growth based on historical market trends and Bitcoin halving cycles. By 2050, sure, it projects over a 1,200% return on investment. But the maximum price predicted decades from now is still just a minuscule fraction of a single cent. The reality is, the algorithm simply cannot process or predict a viral meme, creating a 60% intraday search. It only sees the slow, steady math. And finally, Section 6, the speculative market mirage. Let's talk about the harsh reality. This is the mirage effect playing out in real time. Initially, Bob surges almost 46% on explosive volume. But then, shortly after, the price drops. And it drops not because of some massive sell-off, but simply because the volume completely dried up. In a thin, low-liquidity market like this, just a handful of large sell orders can completely reverse the trend and crash the price right back down. So if you take one thing away from our explainer today, it should be this exact quote from the market analysis. The move is fragile. We've seen firsthand how these tokens are driven by viral memes, automated technical buying, leverage, and ecosystem rotations. But underneath all of that, there is a total absence of fundamental catalysts. There's no new groundbreaking technology, no big adoption news. It is purely momentum. Which leaves us with this final thought. In a market entirely dictated by attention and leverage, what actually happens when the next shiny object comes along? When the meme fades out, the algorithms turn bearish, and the liquidity suddenly dries up, who is left holding the bag?